Dave Boucher here. What I'm going to show here is a general accounting presentation that I've done. Several values have changed for this presentation purposes. So basically, in basic accounting, you got your chart of accounts, and here we have cash bank accounts, several bank accounts within themselves, and then you have a huge one is accounts receivable, billed and unbilled, and then you have your accumulated depreciation and investment area, and of course your accounts payable and sales and so on. So what this also shows is the accounts for if they're going to use SAP or Cognos, it has Cognos numbers, QuickBooks, Peachtree, or other different corporate accounting software, whichever one you want to import all this data into or out of, like we imported all this out of and put it in Excel here itself. Next, so how is this all done? So you have your invoice, you get your invoice, you put all of the data in, and this particular client, we had direct labor involved, and so we put together some formulas here to build a direct labor calculations to where we're going to actually bill the client itself. And then you go through and put this into your journal entries. So what I want to point out here, obviously you have your accounts receivables, but this is an insurance company, so you had a lot of debited insurance expenses that are done by quarter, and you credit your prepaid insurance. And this one client here was growing the past few quarters. Obviously, there's several different types, because there was an insurance company, so there's several different profit and losses of insurance recoverables and different entries itself that had to be done. Now, one of the big areas for this area was consolidated receivable balances. What this is showing is that consolidated. The main thing I want to show is the consolidated adjustments themselves by the major clients. So in yellow here, you can see the billed and unbilled. And then the other major thing, when you go through the unbilled and you usually adjust the entries and to equal the bill, you see the net account receivable balance. Well, that net account receivable balance in this column here is then carried over here to, on a quarterly basis, to net account receivable balance to show all the clients what they have itself for each quarter, taking in the billing in advance and positive value. Now, when you want to look at it based off of an individual client itself, you see your individual invoice with your entry totals and your T accounts. This has everything, from your ARs to your accounts payables to profit and losses and cost of sales. So, that further described, and you can look at it in your trial balance itself to see those even further entries to see a better balance. Now, we want to look at accounts receivable. So we were doing accounts receivable because we wanted to see the aging when the money is coming in. So you see that here this has a major this client here has 10% of its being retained in a retainage area, and 5% due on completion because it's coming in eventually, as opposed to accounts payable itself. Accounts payable, a lot of that's a lot smaller. As you see that here, the retainage is a lot smaller compared to the accounts receivable. Now, a lot of this data is broken into further descriptions. So you have your debits and credits in the accounts and what they were for. And as you can see here, the description in blue, what I want to point out is the cash operate. You see is credited and your multi-accounts is debited, and this is further displayed in the cash disbursements journal, which you also have to maintain. But down here, you obviously go through all the debit and credits for all the entries. You also have the cash operated debited, and this can be seen in the cash receipts journal, and it's balanced out by all the fees that it was credited for. Putting all that together, but for a company, we were building a balance sheet where you have all your assets and your liabilities. But when we look at these assets here, you see the debit and credit, and then all these adjustments. So these numbers are the actual adjustments, that we were talking about earlier, to equal a total balance. You They also do the same thing for the for the income statement. And here, you have your operating expenses and revenue. And after all that's adjusted, you have that year-to-date balance, which for this company here was a negative 961,049. But for that month, because this is just in a month of April, it was 108,984. So this is obviously a bad month, because it's done in April. And I think this company here, its yearly reporting wasn't done in July. Here we have the an aging summary, which what I want to point out is the billed and unbilled area and the retainage for the accounts receivable. Broken down a little bit further, which will be explained a couple times, is how the billed receivables are the 61 to 90 day percentage is the smallest area, the smallest percentage compared to the higher 91 plus billed receivables. You see all those in the 20s, and the current and the 31 to 60 a little bit smaller. But obviously this current is the highest itself, but that's good. But this is kind of bad with the billed receivables being in the 20s. Now, as far as in numbers, you see the broken out. You see that this is a composition of receivables done by the companies like I was showing earlier. You see the net accounts receivable, gross accounts receivable, but the total billed receivables is more what I'm looking for, because I'm comparing these three columns that I was showing earlier. Now, when you look at it graphically, you see that receivables and the current, the majority of them are right here, which are around 150 million, and then the receivables billed are really high for a 91 plus, and so that's kind of bad. That is bad because you have a good majority of them, and you have some of them really high for certain clients. Now, when you want to look at an individual client itself on a monthly basis, you want to go back and look at these invoices. So when you look at these invoices, you see that there's 1 to 30, there's an outstanding, and then 31 to 60. So they have a couple outstanding ones. And you break them down by percentage itself, you see that the current is at 45.54, and then the 30 to 60 is the 8039. So that's, you look at your average sales outstanding, you see that it's 34 as the average for this individual Crown company itself, one of the clients that I was showing earlier. So put all the data together, you want to go on one of the step processes of closing all those accounts and everything. Obviously, you do your bank reconciliation. So this individual month here, we had we added up the bank statement and checks and the deposits, ended up 8225. But then you look back at the checkbook and you see it's that number 8183, and so you have a 7208 difference. So obviously, you got to go back and figure out where that difference is. Now, one of the things that we always have to do is, like I was talking about earlier, is you look in that cash disbursement journal and you see where some of these discrepancies, to see start out to see where the discrepancies are. There are several ways, different ways of figuring out reconciliations, but in this case here, you look at your cash disbursement journal and then the check registers to get your totals there, and then you see that the bank, because of the payroll checks, were a little bit different, and that was not accounted for. It ended up being the two same numbers of balance, ended up being 117,578, and so the difference between the two are now 0. And this is found in the checks and the amounts. In the months, that wasn't because it was reconciled through the outstanding checks, and so we had to go through and find that actual amount itself. So I'll go down here at the bottom. Thank you for this presentation.